Welcome back. So we're here with Kevin O'Leary again from Marvin and Company, and we're doing the second part of our series. We did a three-part series on home ownership and the benefits of that in terms of taxes and how it relates to your return, both from a personal primary residence and also an income property. So we're going to get into the income property element of it, and with regards to that, Kev, I can just check my notes here. Like, what would you say? What are the benefits of owning income property from a tax standpoint?
From a tax standpoint, obviously you have the opportunity to have an investment asset and the opportunity to have deductions against that asset from an annual basis. So as we talked about the primary residence in the first series, getting into the income properties, the primary residence, the rules are very simple.
Okay.
The income-related properties, they're complete 180, very, very convoluted, very complicated. The majority of the time my answer is depends. It always depends on what your situation is, what your income is, things like that.
Right.
We get a lot of people that think that, hey, I'm going to buy a rental property, I'm going to write off all these losses, I'm going to use it to offset other income. It's not the case. You have to be very careful about certain income thresholds and basically what kind of deductions come into play on the income properties.
Okay, so with regards to that, obviously, and on any of these questions, right, if we have specifics that you're going to have or something might relate to you as we're talking about, reach out to Kevin and he'll walk you through that.
Yep.
What's your give him your email
My
address?
email
or website
address
there?
is kpo@marvincpa.com, and the website is marvincpa.com.
Again, that's Kevin O'Leary, and like you said, if something hits on it, just reach out to him and we'll kind of go through that. So, like, I know we talked about, I guess, limitation. Like, is there any specific limitations with your personal income compared to write-offs and number of units you can own or anything? Like,
so really where it comes into play is if your adjusted gross income exceeds $150,000,
okay,
you're not able to use the losses from rental properties.
Okay.
Now, you don't lose them. They become what's known as suspended.
Okay.
So if at some point down the road your income drops below the 150, you might be able to use those losses.
Okay.
And another place this comes into play, and we'll talk about this a little bit in section 3, is if you sell the rental property at some time down the road, all those suspended losses get freed up. So you'd be able to use those losses against any potential sale down the road.
On a gain or whatever?
On a gain, yes.
Okay.
So it's very important to be tracking these as you go along.
Okay. That's interesting. So you don't essentially lose them. You would just maybe not be able to use them.
Right.
Right.
So they have a carryover effect. So at some point your income drops, you might be able to use them.
Okay.
Or at the time of sale, you might be able to use all of them as they get freed up because you're selling the entity.
Okay.
Now the three really levels that come into play on income properties is active participation, material participation, and then real estate professionals. So this is why the rules get very, very complicated because there's different segments as you might have to get to that will limit your losses.
Okay.
But as you get out to being a real estate professional, you might be able to deduct these losses regardless of your income. So there's all types of things that come into play. So very important, I think, to use a professional when you're dealing with these types of things.
Okay. And again, you got questions on these, reach out and we'll get them handled there. Mm-hmm. Is there anything else regarding the income properties that you think is worth going through here?
The only other thing I'd bring up, excuse me, is that if you buy an income property in another state, so being that we have a lot of cross borders with Connecticut, Massachusetts, Vermont, Florida especially, even though Florida doesn't have an income tax, they may have a tangible tax. Other states you might have to file them because you have property in those states. So just make sure that if you're buying property out of state, you're complying with those rules. And then just because you have a loss doesn't mean you shouldn't file because you want that loss to get on record with that state so that when you do sell it, it's there to use.
That makes sense. All right. Well, then what we'll do is we have one more part here. Stay tuned on that part, which would be part 3, and we'll get into the elements of the capital gains and how that would affect you in the process here. Thanks again for tuning in, and enjoy.